this is Claudia here from the Bookkeeping Experts. I told you I would be back, and I am back for more information on QuickBooks, and especially with all the interface changes and QuickBooks and AI. Yes, we're here to help you navigate through that. But today we're going to talk about the balance sheet. We talked a little bit last week about the balance sheet, but now we're going to go on the basics of the balance sheet and what kind of information you can get from your balance sheet so you understand the health of your business. Okay, so without much further ado, we are going into QuickBooks Online. All right, so this is the new interface. And to find the reports, it's on the left-hand side, reports, and here is your balance sheet. But before anything else, I want to explain to you what is the balance sheet. We went over how to fix a few things in the balance sheet. Okay, it's pretty much, your balance sheet is basically a snapshot of your business financial health at a specific moment in time. So it shows what you owe, what people owe you, what is left for you at the end of the day, and also which is known as equity. And basically, there are three sections on the main sections on the balance sheet. And the first one is going to start with your assets. So it starts with your banks, your cash availability, your equipment, and pretty much all your assets, goodwill or tangible and intangible assets. The next thing you're going to see is your liabilities. You have your short-term liability or current liabilities, which means liabilities, things that you need to pay within a year. Maybe short-term loans and so on and so forth, or IOU type of loans that needs to be paid within a year. And there's the long-term liability, which means you pay in more than a year, right? So that's the long-term liability. That's your credit cards as well. So your pretty much anything that you owe, right? Finally, you're gonna have your equity. What is equity? Equity is pretty much what's left to you after all the assets and liability. Okay, there are a few things that you need to know. We use some ratios on the balance sheet to find out the health of the business. We're gonna go through some of those ratios. Okay, some of them are very important. Some of them are key, especially if you're applying for loans and things like that. Okay. All right. So the one of the key ratio that we use from the balance sheet is going to be what we call current ratio or your liquidity. The liquidity is pretty much going to tell how easily your business can cover your short-term debts or your short-term assets. Okay. Now, basically what it is, it's your current assets divided by your current liability. So keep in mind that this is a sample account, so it doesn't have accurate information here. But if I wanted to find out, I'm going to take a look at my current assets, which would be my cash availability, and so on and so forth. And I'm going to divide this number. Let's suppose that it's the current assets would stop right over here. So this includes your accounts receivable, and maybe your deposits and so on and so forth. So my current asset would be 257. Oh, once again, I wanted to remind you that this is a sample account, so we may not have the best numbers over here, but we're going to see that right now. So 257, 814.29, and this divided by all your current liability. And current liability would be like your accounts payable, anything, your credit cards, and so on and so forth, your 401k, then maybe you'll be owing to your employees that, money that you withdraw from their accounts, so on and so forth, your sales tax payable, and so on and so forth. So you have your total current liability here. So you're going to divide the total assets by the total current liability. In this case, the current liability is only only 12,000. So everything looks pretty good here. Too good, right? So if I divide, I'm gonna get a 21, which is extra out of this world extraordinary. But usually that's not the case. You're gonna have a little more current liability here. All right. So anyhow, so this is pretty much gonna evaluate how well you're gonna be able to pay your short-term liability. So if you have a ratio above 1, it means that you're on the safe zone. So in this case, if you're 21, you're definitely on a safe zone. Okay. Uh, the next thing we're gonna find out is your leverage, means your total liability divided by your total equity. This shows how much of your business is funded by debt versus your own investment. Okay, so equity would be your own investment. So a high ratio could mean you're heavily leveraged, mean you're putting a lot of your own money. It's not necessarily bad, but it's worth keeping an eye on. So if you may be able to consider that maybe you need to leverage your um, your debt to equity a little bit more. So sometimes having funds coming from outside is a good thing because you're using your asset wisely and efficiently, and that's pretty much what we're looking for. So in order to find that, you're gonna get your total liability now, not just the short-term liability. You're gonna be looking at your total liability divided by your total equity. Okay, so we're gonna just try it out here. So we're gonna have a total liability of 12,011 with 73, and this we're gonna divide by your total equity, which is 245,802 with 56. That gives a 0.04. Okay. Now, like I said, you don't want this number to be too low because that means you are putting too much of your own capital. The next one is the working capital, which is current asset divided, current asset minus current liability. So this is the dollar amount that you have left after paying off your short-term obligation. Positive is good. Negative could mean a cash flow crunch or something that's not very good. Okay. So in this case here, my current assets, take a look at the current assets. Okay. Total for current assets is this number is pretty high, 257,814 with 29. So this company is doing pretty good. Okay. Minus your current liability. Okay. Okay. Total for current liability is, we saw this number before, 12,011.73. And of course, we're going to have a heavily positive number because this company is rocking in this case. So obviously, you see a different number most of the time. Obviously, you don't want to see a negative number, but yes. All right. So one way for you to calculate all that, you can export that to Excel. If we go up here on the top, see this little page over here? We're going to click here. You can export it to Excel. And from there, you can do all the calculations that you need. There's a lot more ratios, but those are the three most important that I can share with you right away. Now remember, the balance sheet isn't just a snapshot, it's a gold mine, right, of ratios. There's so many things and trends and things that you need to get it from the balance sheet so you can understand the long-term health of your business. The more you use it, it feels more like it's easy to understand what's going on with your business. So, but it is a key financial that companies are going to use. From here, you can have your statement of cash flow because your cash is right here. So there's so much that you can get from your balance sheet. So, by the way, if you're planning on fixing anything, if you know that something is wrong in your finances and you want to find out where those errors are, you're most likely going to find on the balance sheet. So that's how important it is. So before you look at your profit and loss, you must look at the balance sheet and make sure that it's correct, that there is no negative assets, which means that probably you have duplicated expense or something is not right or your reconciliation is not done right. If you see a lot of undeposited funds or payments to deposit, it means that you probably have inflated sales. So there's a lot of things you can get it from here that you're not going to get on the profit and loss, because the profit and loss is going to show all your income and expenses for the current period. Your balance sheet is going to show all your assets, liabilities, and your equity as well. So that's the bottom line of your business right here for the long term. All right, so we're going to go back. We are going to go back. Right. So I hope that this was useful, helping you understand what your balance sheet's all about. It is a very important financial. So you need to understand exactly what's going on. And like I said, you need to know your point of reference to be able to aim high, to be able to keep growing your business, and your balance sheet is key information for that, especially if you're looking to get funds from elsewhere. So if you're heavily invested on your business, yeah, it's okay because you don't have that. Yes, it is. And at the same time, you want to use other people's money if you really want to grow your business, right? So you want to you want to leverage some of that risk to investors as well. Investors that want trust, believe in your business and want to put their money in your business so you can grow. They can grow too. So that's everybody's happy. Okay, this is Balance Sheet 101 Part 2. If you have any question, please write down below. If you haven't subscribed to our channel, please subscribe to our channel. We want to help as many people as possible, and the only way for us to continue bringing content like that to you is if you subscribe, if you share this content, and watch for free key information for you to grow your business or to understand financial or to grow your accounting practice, or if you are just a student to be able to understand what you're getting into. All right. Thanks for watching and spending this time with me. I hope to see you next time. But until next time, keep on smiling.